COVID-19, because of where we've been, we've had an opportunity to go ahead and break out something that we've not been able to work with. I hope that you are going to be benefiting from it. Today, we're going to cover the basics of understanding and managing your credit. We want to review some specific things that can help you rebuild your credit, and also as if needed. It's not going to be magic stuff. It's not going to be suggestions to talk to people and pay exorbitant fees to the companies to increase your credit scores. This is going to be a do-it-yourself course when it comes down to it. So let's go with it. With this, the first thing we want to talk about is what I would call a financial crisis, and that is where we are heading. I'm not necessarily saying that we're there, and it's not necessarily the entire market, but certainly in the credit world, we're watching debt skyrocket, and we've watched this start in the recent years. We had an expectation this was going to happen last year, and we told it didn't. And a lot of it had to do with some artificial things that were impacting. We had people that were receiving higher unemployment payments than they normally would. Or we'd have people with stimulus packages. And so there were people that were able to keep their credit intact. But we're coming to a point where we've got this, and it's really beginning to impact families across the country. You know, even consumers that might not have experienced credit challenges in the past might be experiencing reduction in credit lines. Or worse yet, they may even find denials or termination of credit. There's articles constantly coming out now where creditors are becoming more and more conservative, and they're shutting down credit lines across the country as well. Debt America is going to be committed to helping you provide you with some information that's going to help you understand how credit can affect your lending and what you can do to manage it, help to rebuild, to manage, and maintain the good credit that you might possibly have. We're going to cover the 5 topics that are on this. The importance of credit is going to be pretty clear. Understanding and assessing, I think, is going to be the thing that is a little bit weak. People think their credit score is great, and they don't realize how bad it might possibly be. Understanding credit scores in general, just the fact that you've got a 700 or a 600 or an 800, some people don't quite understand what that means. And not only that, they don't understand that credit scores are not the only part of a credit report. The credit profile, what goes into it, the anatomy, so to speak, is also going to be there. And then we'll cover some steps to work with and build and to manage good credit as well, and I'll cover some resources. But let's start with the basics, and I'm going to define credit. You know, credit's the act of borrowing money, and it's got a promise to repay in the future. Credit report is going to be a person's financial report, and it's going to document the credit history. And the reason that credit is important is for lenders, an individual's credit serves as a tool for the lender to determine their likelihood to repay the debt as agreed. And employers also use an individual's credit report during the process. There's a lot of time in employment now. Insurance companies, even when it comes to the death benefits get higher, and they start going through and they'll actually review credit to determine the risk and also an individual's character. And then also a history of good credit can also allow individuals to qualify for future credit extensions as well as lower interest rates. By the way, if I don't bring this up later, I will tell you, if your credit score is 650 and above, you should be making a regular call to your creditors. I'd say once every 3 to 6 months, and asking for a lower interest rate on your cards. If maybe you'll sometimes get a no, you'll sometimes get a yes, but when you're changing your interest rates by 3 or 4%, we're going to take a look at a slide in a moment that will make you realize how that can really impact you in the long time. Consumers can get the words you're approved, or you can hear the words decline. Hearing the word decline is often really a consumer's greatest fear. When it comes to, even for myself, I've got a great credit score thanks to my wife. She keeps my books in control much better than I do. But thanks to that, I have no concerns for the most part when it comes to getting credit. And yet still, the last time I went to finance a car, I still found myself nervous in my seat waiting to hear the response back. So hearing that word decline can be really nerve-wracking. And the credit guidelines today are much more strict than they've been in the past. And so even consumers that have had traditionally good scores, they may not even be approved for a loan. A lot of consumers don't even know why they've been declined. And the bigger thing is that they rarely know, or they rarely think to ask. And I can't quite figure that out, but that's the problem. When you've got qualified consumers, they can typically get lower interest rates on loans, and that way it ends up having them save quite a bit of money. Having a lower interest rate generally means you have the ability to save more over the term of the loan. And this is where I've discussed as far as always wanting to ask for lower interest rates if you can. Good credit is important because it's going to save you money by qualifying for the lower interest rates. The example here is perfect. You've got a client that's got $300,000 loan and a 30-year home loan. Another one's got the same loan. The difference is one is paying 5% versus 4% on their interest. That's a difference of $65,000 when it comes to interest. And that's a drastic amount. And you think that there's not a lot of houses available for $300,000 on the market right now. So when you're talking about, if you're looking at the baseline in California of the $600,000 median, you're talking about $140,000, $150,000 extra in interest. And so it's going to be significant. And there are millions of records that are reported to the 3 credit reporting agencies each month. The credit reporting agencies are not responsible for the information accuracy. They only report the information that's provided by the creditor. And it's the consumer's responsibility to verify that information that's contained in their credit report. And they need to make sure that it's accurate. And they also need to notify the credit reporting agency about any kind of inaccuracies at the end. If you've ever spoken to anybody that may have said, I've got great credit, I've only been late on my accounts a couple of times, it's really not that big of a deal. You come across people like this, you have to consider the fact that you have to know that it's important to understand the definition of good and derogatory credit. When we look at good credit means simply that there's no derogatories. In other words, no late payments or no over the credit charges or whether or not you've had defaults and things. And so there's going to be any kind of derogatories like that or any kind of poor credit issues that are reported in the past 2 years. We also look for a minimum of 3 open trade lines. And trade lines can be credit cards, it can be personal loans, but most of the time when you talk about a trade line, you think of major credit cards or even some department store cards. But those should be open for at least a 6-month window. Without having that, then you're not going to have a good credit score. It's just not going to happen. When it comes to derogatory credit, derogatory tends to comprise of late payments, collections, charge-offs, things that are pretty straightforward, past due bills on medical bills or on student loans. And one thing that some people don't realize is excessive credit requests, as far as going to the store and I can get 20% off my credit card if I get a new credit card today, so I can go ahead and request a new card. Well, you know what? If you get too many credit card pulls like that, excessive credit requests, you can end up having a negative impact on your overall credit score as well. And then finally, as I mentioned a moment ago, inaccurate information because of clerical issues. And you know what? Thank you. I got questions, and so I promise we'll come up and I'm going to cover Marinella. Thank you for asking that, and it was good to see you yesterday, by the way. Finally, we've got inaccurate information as a result of clerical errors or information from someone else's file. ID fraud. All of these factors can have a negative impact on your credit. I can tell you with personal experience that it's caused in my life sometimes good things, sometimes bad. My father and my son and I, we all have the same name, perfectly, exactly the same, first, middle, and last. And so as a result, when I first got into the credit world, when I turned 18, a couple of my father's cards were on my credit report for some reason. That meant I got credit scores and credit limits that were far better than they should have been. And it also meant that at 18, I had probably a lot more trouble with my credit because I was able to just use them as much. To the other end, now I've had a couple of times where my son had his credit information bleed over onto mine, and unfortunately, because he was younger and irresponsible, his scores actually dragged mine down. So it can have some pretty crazy things when it comes to identity issues. We're going to look at this for a quick second. This is a chart that shows the estimated amount of time and certain types of information that will be reported in your credit report. And as you can see, some information is going to stay on your credit report for 7 or more years. Some people think, oh, well, it's going to be gone in 3. Oh, well, I haven't paid the credit card, so they're not going to collect after 3 years. It doesn't matter. There's a lot more than just the ability for it to hold out. There are some things that absolutely last much longer than that. You'll see Chapter 7 and Chapter 13 will end up typically 7 and 10 years after you discharge that filing. You've got unpaid liens that can be on for 15 years or so. If you ever think that, there's no need to pay that off because they're not collecting on me anymore, the reason for it is that even if your credit score comes back up, if it shows that, and Marinella asked what a charge-off is, so I'll go ahead and address that, is that if it shows that there's a charge-off on there and then you come back to get a loan from me and I'm a new lender, if you've got a charge-off, I'm not likely going to lend to you. And the reason for it is that charge-offs are, to answer your question, Marinella, is the fact that when you don't pay a credit card or a lender for a period of 6 months or more, The creditors need to stop reporting you as an asset. And what that simply means is that if you're paying me on time, I can report to the stock market, to NASDAQ, and I can report that I have you as a stream of income. You are an asset to me. But when you've stopped paying me your minimum payments and you've gone 6 months down and you haven't paid the payments, I can no longer consider you an asset when I put you on my profit and loss statements. So this is an important thing to keep in mind, is that that's something that lasts for a very long time. It also means that it doesn't mean it's gone. The debt's still there, and I still have the right as a creditor to collect on that. But a charge-off simply just means that I'm not any longer looking at that as far as an active bill. I don't consider you as frankly, a valuable client. When we've got a lot of consumers today, we have some understanding about credit scores, but basically a credit score is a numerical representation of how a consumer's credit stands. There's a lot of credit score models, but the most common one that's known is the FICO score. Most people have probably heard it sometime in their lives. This FICO score ranges from 300 to 850. And obviously, the lower the score, the higher the risk. So if you get a lower score, the likelihood is that you're going to find higher interest rates when it comes to financing for cars and for credit cards and such like that. Credit scores are used by lenders to evaluate your ability to pay back debt in a timely manner. And there are 3 things that are needed to create a score. Now, I mentioned to have a good score is to have at least 3 accounts, but to even have a score at all, you need to have at least 1 account that's been open for at least 6 months. You have to have credit activity that has been reported to a credit reporting agency in the last 6 months. And that means that you can't just have an open credit card. It needs to be an open credit card that's got a balance on it, or a personal loan with a balance. It can't be 10 cards that are active but have been there for forever and ever. And by the way, if anybody came on a little bit late, just to let you know, any questions that you can put into chat and there's a Q&A, I promise I'm going to address them, but I'll probably catch them. So you got that credit activity, as I said, within the last 6, and then finally you need to have either a tax ID or a social security number. Without that, you won't show. There's no way to even obtain a credit score because you can't look it up without that security. Your credit score is based on several factors, and the chart here indicates the approximate weight and the level of importance for each of the categories listed. There's 5 categories that really affect the credit score. 35% of that goes to the payment history. Now, that one seems a little bit, to me, common sense. I make my payment, I'm on time, my credit score is doing well. Some people think that that's all that matters. As long as I pay my bills on time, then I'm doing totally fine. But if you look, 30% is calculated on how much money you owe versus how much your credit limits are. That's credit utilization. So if you have a $5,000 credit limit, you have a $5,000 credit card balance, it means you're using almost all of your, you've used all of your credit limit, and that actually adversely affects you. So you want to try to keep, for the most part, about 50% of your balance to the limit. It's a general rule. It's actually a little bit better to bring it down a little bit more if you want to maintain things in a better fashion. But generally, the point that you want to keep it down is try to keep it half of what your credit limit is. Little trick sometimes, if you're a little tight on cash and you can't afford to pay down that balance really quickly, what you can do is you can call a creditor and ask that credit limit to be increased. Because an increase in the credit limit changes the utilization ratio. So it's just a little trick that you can work with. 15% goes toward how long you've had your credit cards. Some people say, well, should I get rid of all my old cards? Not necessarily. It doesn't matter if they're there, if they're active. If the creditor decides that there's been no activity, they may tell you that they're going to close it. But otherwise, I'd say leave it open, because the longer and the older the card is, the better it is for you. If you have 3 cards to pick from and you're needing to get rid of 2 because you just only want to have one, keep the oldest one. Even if the interest rate is higher on that card, keep the oldest one, because that's going to be the one that's going to keep your credit scores a little bit more. 10% goes to how much new credit you've applied for. Now, this is really an important one because, again, I mentioned before, you go to the store and they tell you they'll give you 20% off the purchase if you get a credit card. I know that it happens at Target. I know Macy's. Pretty much every department store offers something along those lines. A lot of the times you have to be cautious with this, because each time you have that credit pull, if you've got excess of credit, you're going to find out that the credit scores will actually end up getting reduced. And then the last thing is 10% of it is determined by the types of credit that you have. Because creditors like to see a variety. They want to see not just credit cards, but they want to see that you're able to pay a loan. They want to make sure that you are paying a car payment, that you can handle revolving debt. and they don't want to just look at one specific. So you have to have a mix in there. That's going to be a help as well. This slide, this lists really the common slip-ups and how they can affect your credit score. And you can see by the chart, and this chart, by the way, was developed by the higher your credit score, the greater the negative impact is when you have something happen. So the more and more that you work to the point where, for example, if you've got a credit score of a 780, you want to try not to max out those cards because the impact is pretty heavy when you're at the 780 score. When you have a lower score, that impact is a little bit less. And the best way I can compare that is if you've got a brand new car and an older car, if you bang the door on the brand new car, your value is going to go down drastically. An old car, not so much. Same thing here. Miss a payment on a car when your credit score is not that bad, your score hit won't be that bad. But when you're a higher score, that you're held to a different standard with regard to your abilities and such. So you can see that goes on. Foreclosure, for example, you've got 780 and above, it's going to hurt by 140 to 160, lowering the score down to 620 or lower. And so there's going to be some significant impact that you want to try to avoid as best as you can as well. There are some steps that you can take to help ensure good credit, and these are really three basic ones that are going to show. First of all, is avoid some of the slip-ups we have in the last. Secondly, you want to obtain a credit report, and you want to review the credit report and make sure that the information is accurate. We're going to cover the anatomy of the credit report in a little bit, and we'll just talk a little bit about what to look for. Don't just look for the score. There's a lot more to it than that. And then thirdly, and we'll talk about this probably quite a few times, is make sure that you correct the mistakes and the inaccuracies. I don't want to tell you how many times I've had people that have called into our firm and telling me that they've got problems with their credit. Oh, but this one doesn't even belong there. That's not mine. I don't know why it's there. Well, that being the case, that's actually dragging their score down pretty drastically. So you want to try to avoid something. So talking about that credit and making sure that we want to make sure that we look at our credit on a regular basis. Everyone is entitled to a free credit report at least once a year. And they can get one from each of the three credit reporting agencies. And you can also get them any time that you've been denied credit. You have to be cautious about websites that offer free credit reports. I hate to say it, but I'm going to say freecreditreport.com because that's the first one that comes to mind. But with freecreditreport.com, you need to be cautious because it's really not free. They have a lot of hidden score, a lot of hidden fees that they don't really realize that are there. Free credit reports also don't normally show you a credit score. There's usually a fee that costs it in order for you to obtain the credit. However, Credit Karma I found is a great resource. They will show you Experian and TransUnion, and you'll get the scores directly from them every single month. It'll update. You'll get notices to whether or not your scores have gone up or down. So you'll hear me talk a little bit about Credit Karma periodically because I just think that there's some value there as well. So the second thing is understanding how the information in your credit report is organized. And again, this is important because a lot of people pull their credit, they look at their score, they close the file, they don't bother to look at anything else. But the fact is, the first section in any credit report you're going to find is going to be biographic. It's going to handle all the names that you might have had over the time that you've applied for credit. It's got previous addresses, it's got your social security number, it's got your employer's names. And this is going to be a really important to read through. Make sure that it's all there. If you've got an employer there that's not yours or that you've never done with, you really want to take a look and make sure that you get that corrected. And we can just make sure that we reach out. I'll show you a couple ways in which to get that done. But definitely want to get that done because it means that somebody else may have accessed your account at one time. The second part is going to be the credit account information. This is what a lot of people will take a quick glance through just to find out if payments are being made on time. It shows the dates that the accounts were open, their credit limits, their outstanding balance, the terms of the account, and also the payment history. The payment history is typically what your lender is going to look at. It shows typically 24 months worth of payment history. And so that's why it's so important to keep your payments on time, because even if you missed last month and that's the only month you missed, that missed month will last on your credit report for at least a 2-year window. And so that can be pretty frustrating as well. The next one we want to look at is going to be the public information section. This one shows liens and judgments, anything that you may have going on with the courts for the most part. This is not something that you want to have a lot of information in. We don't want to have bankruptcies, obviously, if we can help it, but you also want to try to avoid having liens. If you've got property that's owed, you need to keep those payments on time, because if you don't, they can put liens on properties. That shows up here and it can create issues as well. And then that final section shows the inquiries. It tells you who's been looking at your credit report, which can be valuable as well. There's times where you want to take a look at and just find out, why is this person pulling my credit? And so I'm going to go into into detail about the credit inquiries in the next couple of slides. So when we talk about credit inquiries, there's two types. There's going to be a hard credit inquiry, and that's created when you give the creditor permission to pull your credit. For example, it's when you apply for credit and you fill out a loan application. When you go to a car dealer and you want to get a loan on your car, you're going to end up filling in a request to get your credit. When it comes to soft inquiries, Debtmerica is a company that works with clients that are going through troubles with hard times, so we need to see where you are credit-wise. We're going to request soft credit because they're usually made by creditors that are looking at your credit and during an account review, sometimes by creditors that want to extend an offer of credit to you. For example, you've got a pre-qualified credit offer in the mail. Let's say you've been pre-qualified for a credit card or a loan. It doesn't mean you actually get that card. It just means that they've identified you by looking at your credit reports. So you're just going to be aware of that. When it comes to things, you can manage your credit inquiries and you can remove your name from the pre-qualified credit solicitations in the consumer credit reporting opt-out number that's listed here. And this is really important. And the reason being that if you can get away from all those credit solicitations, that also slows down the amount of times that creditors are hitting your account. It takes a lot less issues with regard to inquiries and stuff that we will always recommend that you try. By making it a practice to regularly review your credit report, you can help ensure that no one else is accessing your credit file without your authorization. One thing to keep in mind, if you don't recognize an inquiry, you have the absolute right to call the creditor and obtain more information about the inquiry. The other thing to realize, though, is that sometimes creditors may use other companies to pull your credit. Last time I went to finance a car, I went to finance through Toyota, and while I was financing Toyota, I couldn't figure out why I was getting a credit pull by Chase. Well, Chase was their credit systems that were working at the time. So there are going to be sometimes credit inquiries that are going to have different names. Don't panic on it. Just don't hesitate to go ahead and check it and ask. It never hurts. For additional information on that, you should go to visit the FTC website. It's a great informational source, and it's got some data there that will be able to help you. So far, we've covered a little bit of information, hopefully not too much. I haven't put you all to sleep. We won't cover obviously the definition of credit, its importance. We talk about credit scores and inquiries and the type of information that's contained in. You want to make it a practice to order your credit report at least once a year, or whenever you get denied credit. As I mentioned earlier, the credit report agencies receive millions of records each month, and it's really inevitable that a mistake is going to happen. And so it's up to us to ensure that the information contained in the credit report is accurate. I say check at least once a year, but personally, I have a Credit Karma account. I watch it once a month. It opens up. If I have something I don't spot, I clear it up right away. It makes life a lot easier. It also makes sure that you don't have to go searching back 6 months to try to figure out what happened when you can simply do it that way. Once you've ordered and reviewed the credit report, it's important that you contact the credit reporting agency so you contact and correct and fix all those errors. You got to keep in mind that not all the creditors report information to all three credit reporting agencies. So it's really wise to order all three. And you can do it from a variety of ways. As I mentioned before, during page 11 again. You know what? Phyllis, I can at the end if you ask that in a little bit, because we're going to go ahead and flow through this. I still have to tell you a question. So when you've got this, it's really wise to follow up directly with the creditor as well. You have to keep in mind that they don't report to all agencies. And so just because you're finding that everything is clear on your Experian account doesn't mean that you don't want to check Equifax, doesn't mean you want to check TransUnion, because not everyone has everything. So you may find that you've got a great credit score with Experian, and Equifax, you don't. And the reason for it is maybe one company doesn't report that to Experian. So you need to check on all of those. And you also need a current copy in order to file any kind of disputes or correct any kind of discrepancies or anything. It's also wise to follow up directly, as I said, with the creditor, because you want to correct the error with the creditor because they're the ones giving the information to the reporting agency. So you may fix it at the reporting agency's level, only to have the creditor then send the wrong information again next month or 2 months down the road. So whenever you fix an issue on your credit report, you also want to make a point to get back and to get that. So, we've covered some of the things we reviewed, covered credit basics. And we want to talk a little bit about ways that we can help rebuild the credit if you've experienced hardship. The first thing to understand is that the hard truth is there's no easy way. It takes time and it takes patience to rebuild your credit. You'll find ads on the internet, you'll find ads on the radio, some companies, and I don't want to mention any names at this point, but you'll have companies that will offer for, $100 a month, they'll do credit monitoring and they'll make sure that they'll increase your credit score. If you're paying somebody $100 a month to take care of your credit, there's no incentive for them to fix everything right away. It just doesn't happen. There are some companies that promise to increase credit scores, and there's good success, but then also there's just as bad success. I've spent a long time in the mortgage world and found that there were really nobody that had any companies that had great reputation on this, so I stay away with it. I say, you know what, work on this on your own. Just keep in mind that you're going to spend a little time. There's some real easy basics. One is develop a budget, track your spending, pay your bills on time, pay down your debt, and paying down your debt is going to be probably one that's going to be critical. With World Financial Group, the phenomenal thing is that you bring this part to the client. I can tell you this and tell you that these are some of the basics. If you want to bring this, as I mentioned earlier in the session, if you want to bring this class to your team as well, we can do this. But really, it's going to be you working with your clients to help them develop that budget. Another thing is going to be important. Don't apply for unnecessary credit. I can't say it enough. Don't get that new card over at Macy's just so you get 20% on that new purchase. The reason being that credit pull is going to bring your scores down, which may end up costing you higher on your interest rate somewhere else. You want to try not to apply for unnecessary credit, and you don't want to overextend yourself so you can't get yourself back out. If you get to a point where you're overextended, there's no way to pay down. Revolving debt is developed, so if you're making interest payments, they'll keep you in debt forever. Knowledge is really power. If you get declined, you have to call, you have to ask, you have to find out exactly the reason why. And one of the things that happens is that you can also ask which factors weighed most heavily toward those decisions. So those could be the things that you can really focus on. So we cover the credit basics. And we talk a little bit about different steps as far as managing your credit wisely. First section is going to be obviously credit. You check the credit once a year. Anything you get denied for credit, we want to make sure that we find out. Second, we want to always consider signing up for a credit monitoring service. You'll hear me say Credit Karma, and I'm sorry, but that happens to be my favorite. I've looked through a variety of different services over the course of my time at America and working in a mortgage firm. I found that they tend to be the most solid that there is. There's a lot of services out there that they can help you with, and there's a lot you just need to research and find somebody that you're really comfortable with, and just make sure that you're going to get the proper price if you're really going to go that way. I'm not super keen on paying for credit monitoring. I guess you probably figured that out. When correcting errors and inaccuracies, you just want to make sure that you work both with the creditor and also make sure that you go and take that reporting information and make sure that the credit bureau also has that same information, keeps it accurate. And then finally, we want to keep you on track by developing a budget that you can live with and that you can stick to it to ensure that you can pay your bills on time and pay down your debt. If you co-sign for someone on a loan, one thing you want to keep in mind is you are 100% responsible for that loan. If the other person is unwilling to pay or has to default for whatever reason, you are absolutely 100% responsible for that. There's no getting out of it. You can't call up a creditor and say, can I take my name off that because I'm concerned that he's paying? That's the reason it's there. You co-sign saying it is absolutely okay, and I promise that you're going to get paid on this loan. And if the person that's lending, I will take care of it. So you don't want to co-sign on a loan unless you can afford to make those payments on the loan yourself, because it'll just get you into a lot of trouble. The one thing to talk about on this also is student loans. If you have a student that's going to be 26 or over, I always recommend that you don't get involved in the student lending. Don't put your name as a parent on the student loan. Let the 26-year-old borrower go ahead and process that loan first. And the reason for it is that there's often times where when your income is not taken into consideration and it's simply the students, then they can qualify for a higher financing because of the fact that your money is not there to be seen, so they'll figure, well, you need to have more money for that loan. If you feel that managing your credit is going to be overwhelming, you can always work with a debt settlement firm. Obviously, Denmark has been partnered with WFG for a decade now. We have a fantastic reputation with you. But if you are going to work with another company, then my recommendation is a thing called the American Fair Credit Council. And it's a nonprofit agency. If your debt settlement firm is not with that AFCC company, you really don't want to be involved with them, because there are certain guidelines that every company that's part of them need to follow, and a lot of that's got to do with self-auditing and self-monitoring that's kept the industry really, really slow. So you're going to want to do that. So you make sure that you take a look at that. The other thing to do is consider, before meeting with a consultant, you have to consider what your goal is. For example, if improving your credit is really important, then debt settlement might not be the route to go. However, if you're looking to pay down debt and you're having a hard time doing that, then by all means, we may be a solution. So that'd be the way to go. You just need to make sure that you have realistic expectations, and that things are not going to improve overnight. You cannot expect it. Clients that come to us normally see a 2 to 4 year window. If you're working on it and if you've gotten through it on your own and you're paying your bills off and just staying focused on paying on time, normally credit scores can get into a pretty healthy state in about a year to a year and a half. So that's going to be the one thing. Just keep in mind, it's not an overnight thing, and it's not going to be there. I'd like to touch on this for just a quick second. This is identity theft, and I'm not going to spend much more than just a moment or two on this, just so you understand. Identity theft is basically fraud. I take a social security number, I've got a credit card, whatever it may be. You just want to be really aware that just before you jump the gun and you go to file things, it's considered fraud, which is a crime. So just realize that most of these things occur by people that we know. Unfortunately, whether or not it's a friend that stops over and picks up a credit card, or if it's a son or a daughter that happens to, open up an account in your name, and I hate to say it, but these things happen. You just have to keep in mind, identity theft is considered a fraud, and it's considered fraud, and it's also a crime. So you really need to make sure that you know who that person was, and if you absolutely don't, then go ahead and follow them. The FTC is a great way to go as far as any kind of fraud contact in place. So you've got that down at the bottom of the thing. It's just ftc.gov, and you'll be good to go. There are 5 things to remember about credit. First thing is credit score is going to be providing a quick snapshot of your credit risk. The second thing is that the credit reports are that you order yourself don't affect your credit. Those are soft inquiries, not a problem. The higher your score, the lower the risk. And finally, fourth is that low credit scores might affect your ability to obtain a loan or employment or insurance. And then finally, you can really protect your credit by just knowing what's on your credit report and monitoring that and keeping those things in mind. There are some laws that are in place, and I've got to put this out just so you can take a look at them. And if you want, I invite you to go ahead and do your own research on them. They're pretty interesting. The Equal Opportunity Act basically says I can't discriminate. If I'm a lender, I need to give everybody a line. There's a thing called the red line, where lenders used to look at an address and say, no, the address is in the wrong neighborhood, we're not going to lend to you. So redlining is illegal. So that's going to be the Equal Opportunity Act. Fair Credit Billing Act tells you that you have to be able to provide a bill that's legible. This changed not too long back. And so it's really, if you looked at your credit card statements from now versus 5 years ago, 5 years ago, they would tell you what your payment was. Now they tell you what your payment was, and if you make that minimum payment, how long it's going to take you to pay it back. So it gives you the incentive to make sure that you're overpaying on your bills. Fair Credit Reporting Act, same thing, talks about who can see your credit after you've authorized a credit report. So you've got that, and also the fact that you've got right to get data back if you get this decline. And then the Fair Debt Collection Practices Act are the game rules that debt collectors need to follow by. And there's very strict rules there. If you are having troubles, if you're being harassed by creditors, then I would suggest you do a search on that Fair Debt Collectors Practices Act. It's also the FTCPA. Just do a quick Google search. You'll get the gist of it, and it'll give you some guidelines. Moreover, if you're having problems, obviously consider getting in touch with us, and we'll be happy to work with you as well. So, congratulations, first of all, to taking the first step in understanding and managing your credit. With some of the next steps, we would encourage that you use some of the tools and some of the resources we covered in this course now. If you do need to, you can contact either HUD approved for credit counseling. Credit counseling is not going to be a big savings money-wise, but it will be somebody that can help you budget, or you can talk to somebody with debt settlement, either one, if that needs to be done as well. And then also just continue to manage your credit wisely. And that's going to be one of the main focuses on this. I'd like to thank you all for taking the time for participating in this class. What I'm going to do now is I'm going to open up to see if we have any kind of questions. You can do this by either Q&A or by the chat. I see that there's a couple up there, so I'm going to go ahead and take a look at it. And you know what I'm going to do is I'm going to bring it back to page 11, because first of all, somebody asked me for page 11, which was there, and hopefully you've got that, and we'll go through the questions here. The first one, we talked about the charge-offs. Charge-offs are debts that creditors are no longer reporting on NASDAQ, or they're not reporting on their asset column. However, it's still a live debt. It's not gone away. So if it says charged off on your credit report, it doesn't mean you don't have to pay. It does mean that what will happen is that in the next 3 to 6 months after the charge-off, that debt will get sold to a collector. And from there, you'll possibly see collection efforts made by a more aggressive thing. So if you can avoid that, you want to do that as best as you can. The next thing would be, can we repair credit reports, credit with multiple charge-offs? Angela, the point on this is that if you've got charge-offs, technically that debt is still alive. It's just not being reported from the creditor's perspective when it comes to their business. But when it comes to you, they're saying that it's still a live debt. And so the only way that you're going to be able to really effectively repair your credit is to work on those charge-offs. Charge-offs normally mean the creditors are 6 months or past. My suggestion would be on this, and I promise that this is not a product sales class or not a Debt America training class, but I would recommend that you get out and take a look at what we might be able to help as far as getting the debts maybe all settled, so we can go ahead and eliminate that and clear that debt off your list. That would be by going to wfg.debtamerica.com. So I'm going to go back down to that bottom. I'll leave this page there because that's got that link down at the very bottom of that page. So we've got that. Go down a little bit further and we'll find out. Employment is employment credit pulls hard or soft? That's going to be a soft pull. Eric, thanks for asking for that. They're really the credit pull. When it comes to a hard inquiry, is typically where I'm looking to lend you something, typically to say you're going to go into further debt, and so potentially you're a risk to another creditor. So if you're applying for a loan with one bank and then you come to me and want to pull credit from me as well, I need to know that you may be getting loans from different places at the same time. So that's the purpose of why that causes that score issue. Very informative info when we're meeting with your clients. And you know what, Dennis, I appreciate that. Good to see your name pop up. Thank you for jumping on the course. Once again, this class, you're welcome to share what you've got from us. Great. But what I'd also say is we can take this class and we can put this put it in front of all of your clients in your office if you'd like. So discuss with your SMDs, discuss with your folks on the team. Just say, you know what, why don't we just bring a pure educational class out to our clients and see whether or not we can bring in a bigger group. That's a big target for this session. The other reasons that we've used it have been for church groups. There's a gal that's up in Northern California that works in a circuit of churches. So she goes once every 2 months to each different church and we present this, and it's been really, really well received. So anything that you'd like on that, just let me know. If you've got a charge off, but you did pay it, but it still shows in the credit as a charge off, what can you do to clean and fix this? So Blanca, to answer that, if you go into your credit report, at the very bottom of the credit report, you should have a section that's got all the contact information from the creditor that's showing that charge off. Now, I'm pretty sure that Credit Karma does that, but definitely the ones, if you go to annualcreditreport.com, and I'm going to type that into the chat so you have it, and you will. If you go out to that site, what will end up happening is you can get all 3 credit reports, and those definitely at the very bottom of the page will show where there's derogatory comments and who those creditors are. So you can call and make a call to them, or if it's got a correspondence only class, you just need to say, look, this is no longer my debt. I've already taken care of it, and it doesn't take much. Normally it's about a month or 2 to get that cleaned up. You work with, let's see, Wanda works with collection agencies, and if someone settles their debt, depending on the company, that debt will show as settled. And you know what? You're absolutely right. That's just about every debt that gets settled says debt. It says settled. And by the way, settled is not a terrible thing. It's what happened, and it happened, and it's done. The difference between a settlement versus a charge-off is it means that a settlement has been where the creditor has actually negotiated with the client and agreed to take an amount that was less than was due. From a short-term basis, it's impactful because they say, well, you didn't pay everything that was due. Long-term, however, it really isn't. It doesn't keep that credit score down by any means. Charge-offs will, the settlements don't. Then I'm going to go and jump over to some of the others. I want to know why your FICO are so different from one agency to another. And I'm sorry, I don't mean to chuckle at that, but that's been a question that I've had for some 25, 30 years. Each one of the three reporting agencies, they have a little bit more emphasis on different things. One may look on payment history, the other looks at credit utilization, but they each, while the FICO score is the scale is there as a basis of guidelines, the three agencies all look at them in three different fashions. And so it can be really frustrating with that, especially, you know, as you're saying, if you got one for 795 and 726, I can tell you I have a similar scenario to that. I've got about a 50-point disparity between two companies, and it drives me crazy because I like symmetry. The three different creditors, not creditors as much as the credit reporting agencies. I think this is for whoever Anonymous is. So the three different reporting agencies are going to be Experian, Equifax, and TransUnion. And the best way, as I put that link in the page, is annualcreditreport.com. The best way to get hold of them, to get credit reports from all three, is just to go annualcreditreport.com. They'll give you a little breakdown. They'll say, which report do you want? Ask for all three. Don't just ask for one. As I said, sometimes there's information that doesn't say. Credit card, Chase Bank shows my credit score. Is this bad? No, as a matter of fact, that's great. The Chase Bank, however, I believe they show you, it may be your Vantage score. It may not be TransUnion or Equifax. Vantage is a new system that they've tried to put into place where they could take the score, and to answer that, to go back to that issue about one person have a 796 and the other one having a 726 credit score. That Vantage 3.0 score is supposed to kind of combine all three and give you a general number. It's not bad. The only issue though is that most creditors don't use that. And it's also, it's a friendly score in that it's a little bit higher than most creditors will end up showing you as. So just something to consider. Credit Karma used to be on Vantage, but now they split and they do, I believe, Experian and TransUnion. Equifax does not show on them. Constant asks, does debt settlement impact your credit score? If so, how? Constance, the settlement process is, I'm not going to go into too much detail on this because I promised I wouldn't when we were setting it all up. It was going to be our systems only in as far as how credit reports work. However, just so you're aware, the debt settlement world, the way I'm going to need to work with your clients is to have you stop making your creditors payments altogether. Instead of the payments going to the credit card companies, money goes into a bank account. When there's money there in the bank account, we negotiate the debt down to a lower amount. So that part of the debt settlement process of holding back the payments to the creditors, that's just like not paying your cards. So you're absolutely going to have a negative score. By the time you're about halfway through our process, your scores then start to inherently grow by themselves because most of the debt gets settled by then. And then by the time you're out, it takes about a year and a half, and you're going to find yourself into a better state. More questions. After debts are settled, how long do they stay on a credit report? Was it 7 years? And Tyler, that's a great question. That one I'm going to go back in. Actually, for debt settled, I believe it is a 5-year period for it to show that it's been settled. But from a lender standpoint, I will tell you that I don't care about something that's settled. And I'm sorry, I'm trying to get back to, I think we were talking about this page. How does it impact your, I forget why I was going to go back to that page. Anyway, so Tyler, to your score will be on for it'll be on your report for that 5-year period, but it really doesn't matter. And what I mean by not mattering is if I'm a lender, I look at your score now, and then I look through your report and I look through the account information section. If I see a charge off, it means that that account is valid and it's still open and you still owe debt to that. So you're frankly a liability to me. So I'm not comfortable. I may give you that $5,000 loan today. And then after you get that $5,000, then you end up finding, and I'm going to just flip back. I hope you don't mind to the camera. Once you get that $5,000 oops, sorry. Yep, so I may have settled that debt for 5,000, but once it's settled, it's done. It's gone, it's nowhere to be found, or it'll never rise its head again. If it's a charged off 5,000, that's a different story. This charge off means that a lender can come back and start collecting somewhere down. So I've given you a loan now, and some charged off debt may come back to life 2 years from now, and all of a sudden you can't deal with them and me at the same time, so you default on me. And that's why I don't want to lend to somebody that's got charge-offs. But if you've got a debt settled, it doesn't matter, because it indicates that you're not going to run away. If you've got a hospital bill collection, it's been 7 years, is it worth paying it off? If it doesn't get paid off, it'll drop off in 7. Tiffany, I can't speak specifically to that. And the reason for it is that the statute of limitations and the way that things fall off of credit reports like that is a little tricky, because you may have a debt that is 5 years old, but as long as they are continuing to attempt to collect from you, if you have not heard from them for 5 years, then the likelihood is that in 2 years you're going to be fine. Yes, leave it alone. Okay? But if you've gotten a call from them occasionally, if you've had a conversation, if you've had any kind of discussion, then in those specific instances, you have to be a little bit more cautious, because any kind of conversation will mean that clock starts ticking again. So it's back from 5 years, now it's back to 0. So it's a reset on that. By the way, I've got quite a few people that are raising hands, and that's the hand thing is, let's see. Yeah, I don't know how to do a hand raise thing. So do me a favor if you all can. If you've got a question or something, you want to ask a question, please feel free to. But just do it by putting it onto the chat, or doing it by putting it into the Q&A, and I promise I'll get them for you. The hospital bills, we've got that. Got settled. After debts are settled, how long do they take? Okay, I think we've caught up with all the questions, and it looks like we may have gotten everything. I do have at least one more hand up, and so if I haven't answered that person's question, I apologize. Again, this is the one part of Zoom that I always get a little confused by, because I can never find those hands. So anyway, well, look, I want to thank you all very much for taking the time today. Debt America and World Financial Group's partners. We did have Blanca said, do you guys do home liens, home loan debt, foreclosures, debt corrected? So we can't do home loans that are actually outstanding loans that are active right now. But if a foreclosure has occurred and now they're asking you for money that you haven't paid because they didn't make all that money back. So for example, you owe a $100,000 loan, they foreclose on that loan, and they auction it off, but you owe 100,000, they auction it for 50, you still owe the extra. So yes, we can absolutely look at that without a doubt. But what I was going to say at the very beginning, Debt America and WFG, we've been partnered for a decade now. Our goal has always been to work with clients and to help them get through their issues and their problems. Our goal is always to help you, to help you be able to overcome the objection that says, I can't afford it. That's where we are. That's what we do. So I'd love to be able to get out to as many of your offices as you possibly can. Feel free to touch base. Sangiri had mentioned the fact that you wanted to share about today's presentation. Are you able to share our team? Absolutely, without a doubt. So I'll tell you what you can do. Sangiri, I'm going to put my email address here, america.com. And you're welcome to go ahead and drop me an email and just say you'd like to set something up for your team. And then in the meantime, I'm going to see if I can find you as a contact in the registrations, and we'll go from there. But please feel free to touch base with me directly, okay? Thank you again so very much. And if it feels like this is something that there's value to, I think we may end up including this as a general session more regularly. That way, when new agents come on, then they can go ahead and benefit from this as well. So thank you so much, and I do wish you the very best. Okay, thanks.